Alrighty, well, thank you very much for joining me today here at My Financial Coach. I'm excited to share a little bit about what we are doing to help our clients and the highly compensated medical professional space with thinking through their tax situation. This has come as a lot of our clients have asked us to work either directly with their CPAs, their tax preparer. And what we found is there are a lot of things that CPAs are really good at doing, as well as any tax preparer. But based off of our interactions, we've noticed, hey, there's actually an opportunity for us to improve tax outcomes based on a coordinated approach when it comes to financial planning. So for today's agenda, what I'd like to do is introduce myself a little bit more. And from there, I'd like to share a little bit about what My Financial Coach's tax focus looks like. And then our philosophy towards that lifelong tax saving strategies and what you could do next should you be interested in learning more about My Financial Coach and our tax planning. So I'd like to introduce our tax team. We do have a few CFPs that work here at My Financial Coach who will ultimately be partnering with our tax professional team. This includes our Director of Tax Planning, who has a JD in tax law, as well as an enrolled agent who will focus on the day-to-day filing. And we have a bookkeeping consultant who is able to help our business clients with their bookkeeping needs. And what we found is that when we are able to more directly partner with a tax team, when we identify tax strategies, we're able to actually get the tax advice directly to our clients. Because a lot of the times there is a concern that whatever strategies are being presented may not make sense to the CPA or the tax professional who ultimately is filing whatever strategy is being implemented. So rather than present a bunch of really good ideas that may or may not pass muster, what we found is let's take the ideas to the tax professionals first, get their thoughts on it, and then from there, present our clients with the best overall lifelong tax savings that they have available. So let's talk about the business models that we've seen so far. So a lot of our clients are highly compensated, and their compensation can take a lot of different forms. If they're a business owner, they may have the ability to get 1099 income in the form of distributions. Maybe there's some K-1s involved where they're a partner in a firm that allows them to get some additional tax benefits from holding that position. But I think that there is a large majority of our clients who have W-2 income. And traditionally speaking, there are only a handful of ways that you can offset your W-2 income. Some of it has to do with owning real estate. For example, if you have a mortgage, that allows you the ability to deduct your interest income. There's a few people that are charitable. However, we have found that since the standard deduction has been increased by a large amount, a lot of our clients that traditionally were saving a lot of money on taxes through these strategies may no longer be getting those tax savings that they historically were able to take advantage of when standard deductions were lower. So how are we able to go beyond this and really evaluate what's going on? Well, I think traditionally, when you go to any tax preparation firm, you want to know that your taxes are being filed correctly, but you're also hoping that they can help you save money on taxes. Now, a lot of our clients, when they're evaluating CPAs or tax professionals in general, we found that a lot of them are coming when the taxes are due. Well, a lot of the times taxes are due the following year of when the taxes are paid, especially if they're in W-2 situation. And what that means is a lot of the ways that someone is able to save money on taxes, really that should have been calculated in the previous year. So if I'm trying to save taxes for 2025, by the time I'm filing my taxes in 2026, I really am limited because what I should have been doing should have actually happened in 2025. And so that's where we have found that the traditional CPA model is really starting a little later. And what we've also found is when you're done filing your taxes in April, you might be tired. You might want to just take a little break from tax planning and tax mitigation. And so now you're getting into the summertime potentially, you're going on vacation, then one thing happens and maybe your whole year is being thrown off whack again. And before you know it, you have the holidays and it's a mad dash until essentially it's the next year and then you're filing taxes yet again. So filing taxes accurately is very important. And that is absolutely what the traditional CPA model is good at helping clients do, because you are going to them with the premise that they're going to go and file your taxes. In fact, that's when you pay them. And when it comes time to try to save money on taxes, a lot of the times our clients are very surprised that they're often the ones bringing the ideas to their tax filer and preparer after the fact. For example, you might have bought a home and taken out a mortgage, and then it's after the fact that you tell your tax person and they'll tell you, hey, you saved this much money on taxes because you bought the home. But really, when either a financial advisor is bringing a tax idea to their client and then they're bringing it to the CPA, or maybe you're reading articles online about some sort of backdoor Roth strategy or putting money in a Section 529, it will be you that is motivated to save money on taxes. And your tax preparer may or may not make any additional money should you save money on taxes. Indeed, just looking at their business model, they are being paid after the taxes are filed. And if you add additional complexity to your taxes, it takes longer for them to file your taxes. So for us, what we've thought about here at My Financial Coach is not necessarily filing as the goal. Filing is important, and I think that it needs to be accurately done. However, our focus is going to be on the tax planning with filing as a requirement, but not the focus. So we think about your tax goals in total. What are you trying to do to build wealth tax efficiently? And I think people don't realize, but even if they don't have a strategy written out yet, they absolutely are doing something to help with their tax situation. And I think the most common thing that people do would be putting money away in a retirement account, or perhaps buying their property and taking out a mortgage and writing off the interest expense. And so all of these items, they have tax implications that happen not just in the year that you are actively engaged in these activities, but they have a whole lifelong and even year-to-year implication. So for example, you open up a retirement account, you deduct whatever it is on your taxes based on your contributions. Well, in the future, when you take that money out, you're potentially having to pay money on the dollars that have grown now with the power of compounding. Also, if you were to buy rental properties, potentially down the line as you continue to grow your income and you continue to pay down the mortgages, you get less and less interest for each one of those payments. That's going to have a lifelong impact. And at some point, as you're writing off your depreciation, if you were to ever sell your property, you may have to recapture all of that depreciation in that tax year. So there are a lot of different things that our clients come to us with to try to mitigate their taxes in the current tax year. But there is a lifelong implication to the taxes that they are currently saving down the line. Since we know that that is going to be an issue, what we try to do is get clarity. We try to understand our clients' overall financial picture and wealth building picture. So we are going to take a look at what our clients have already done to try to save money on taxes. Very few people do nothing at all. They don't try to be abusive, but they don't try to overpay their taxes if they can help it. So let's see what has already been done. Are your taxes being mitigated, or are you taking the standard deduction? Because if you're taking the standard deduction, it's actually not that difficult to do your own taxes because you're no longer requiring someone to really sort through that much. And there's really not that much risk in filing your taxes yourself because you're not doing anything creative. And looking at what you could have done over the past 2 years, is there anything you can do this year that you really should have been doing in the previous years? These are things that are maybe a little backwards looking, but that's at least going to tell us, hey, is there anything that you're creating for yourself down the line that we can see in your tax forms? Because your tax forms tell a story. They tell a story of what your tax strategy is going to be. Now, I will say that if anyone here has an investment portfolio, whether they're stocks, bonds, ETFs, mutual funds, you know that you have a certain risk tolerance. And what that risk tolerance could look like is you just want your money sitting in a bank and you don't care if you don't get any investment returns, but you just want to make sure your money doesn't go down from whatever activities the money is doing. All the way to maybe something more aggressive where you're buying derivatives, you're buying options, you're buying all sorts of speculative assets or private equity type deals. And so just like how your investments have a risk tolerance, your tax also has a risk tolerance. You may be very tax risk adverse, where your strategy is to take no deductions at all and just go with the standard deduction. You don't want to deal with itemization. Alternatively, you may be exploring very, very aggressive tax saving strategies. In fact, I have read many articles where there are influential financial influencers who have positioned the idea of hiring your children to work in your office and potentially paying them up to a certain amount so that way you can help them start their retirement accounts. So there's a wide range of risk to every tax strategy. And I think that oftentimes there's a wide range of results. And so at My Financial Coach, we try to understand, hey, what is your tax risk tolerance? And is the juice worth the squeeze? Are you potentially putting an IRS bullseye on your forehead for maybe, in the grand scheme of things, a few $1,000s of tax savings? Or are you potentially taking what is a rightful deduction and you're putting perhaps tens, if not hundreds of thousands of dollars back into your wealth picture over your lifetime? Because what might save you money today in taxes may cost you a lifetime's worth of taxes well in excess of what you're saving today. And so we try to find that sweet spot for our clients. And it could be a situation where you're not just doing one thing, you're doing a confluence of things. Maybe you're buying rental properties while using some of that money to offset against your active income, because now you're actively managing your rental properties, and you're also potentially consulting for other rental properties and setting up a retirement account. All of these things come together to give you a sense of how much you are saving in taxes today and in the future. And all of this comes together because you're going to create a lot of different ways that you are building up wealth, because a dollar that you are able to save in taxes could go a lot of different places. It could potentially go into increasing your lifestyle spending, which some people think of it as a net loss, but hey, your family deserves to have a certain amount of comfort. You deserve a certain amount of comfort for your hard work, so there's nothing wrong with that. But should you decide to save your money that you're saving on taxes, the question becomes where, and is that creating more tax problems for yourself down the line? Let's say you are able to save hundreds of thousands of dollars by investing in real estate. Are you then taking that tax savings and buying more real estate? And is that going to create more lifelong tax burdens for you? And if so, how much? And is there a strategy to avoid that? There are plenty of individuals that say, hey, I'm actually never going to really pay that much money on my real estate, because what's going to happen is I'm going to pass away. My children are going to get a step up in basis. And actually, I'm just going to be able to never really pay that much money on my real estate. But what they may not realize is all throughout this time, they've been paying property taxes as a matter of course. But also there is that concern of, hey, what if you're living in a state that has an estate tax? So when you pass away, your children are potentially going to have to pay taxes on the value of all of your real estate now. And there is, at least on a federal level, an exemption up to a certain dollar amount, but there are some states where there is no exemption, or there is a very low exemption. So I think that there are tax concerns. And unless you're looking beyond this year's 1040 and looking at all of your assets that you've accumulated, you might actually miss where you're going to be overpaying in taxes. And so at My Financial Coach, we do have a membership fee service where for an onboarding fee and a monthly fee, you will get access to our tax team, which will include the tax attorney, the audit support should there be any situation where you have a paper audit. You will be able to get your taxes filed every year, as well as discounted tax services above and beyond should you need additional support. We also have the ability to add your personal certified financial planner to the tax team, who will help you really understand what assets you have, uncover any tax mitigation that you could achieve by arranging your finances in a way that is better coordinated with the tax team. And there is also the ability to bundle these services together at a discounted onboarding and ongoing monthly fee to account for the fact that you might make less progress immediately because you have multiple things that you would want to focus on all at once. I appreciate you for joining me today. As far as next steps go, if you'd like to learn more, I encourage you to go to www.myfinancialcoach.com and go and read more about our tax planning services. This is going to be under the Our Offerings tab, right under the Financial Primary Care membership.